Diving into the market. Why understanding the lingo matters. The stock market can feel like a foreign country. It has its own language. When you first encounter it, the jargon can be overwhelming. Terms like bull market, bear market, dividends, and capital gains might sound like a different dialect. But don't worry, it's not as complicated as it seems. To succeed, you gotta speak it. Don't worry, it's easier than you think. Just like learning any new language, it takes time and practice. But with the right guidance, you'll be fluent in no time. Think of it as learning the basics of a new language before traveling to a new country. You wouldn't go to France without knowing how to say bonjour, right? We'll break down the essential terms. Understanding these terms is key to making smart investment decisions. For instance, knowing what a stock is versus a bond, or understanding the difference between market order and limit order can significantly impact your investment strategy. These terms are the building blocks of your financial literacy. It's like reading a map before a road trip. You need to know where you're going. Imagine planning a cross-country trip without a map or GPS. You'd likely get lost, take wrong turns, and waste time. The same goes for investing. Knowing the lingo helps you navigate the financial landscape, avoid pitfalls, and make informed decisions. Once you grasp these basics, you'll navigate the market with confidence. You'll be able to read financial news, understand market trends, and make decisions that align with your financial goals. It's empowering to take control of your financial future. You'll be on your way to building wealth. Let's get started. By mastering the language of the stock market, you're setting yourself up for success. Whether you're a novice investor or looking to refine your skills, understanding the lingo is the first step towards achieving your financial dreams. So let's dive in and start this exciting journey together. Let's start with the basics, stocks and shares. Understanding these fundamental concepts is crucial for anyone looking to dive into the world of investing. Stocks and shares are often used interchangeably, but they essentially mean the same thing. They represent a unit of ownership in a company, giving you a claim on part of the company's assets and earnings. A stock represents a piece of ownership in a company. When you purchase a stock, you are essentially buying a small part of that company. This means you have a stake in the company's future success or failure. The value of your stock can increase if the company performs well, or it can decrease if the company faces challenges. When you buy a stock, you become a shareholder. As a shareholder, you have certain rights, such as voting on important company decisions and receiving dividends if the company decides to distribute profits. It's like becoming a part owner of a business, even if your ownership is just a tiny fraction. Think of it like buying a slice of pizza. Imagine a large, delicious pizza representing the entire company. When you buy a share, it's like getting a slice of that pizza. The size of your slice depends on how many shares you own. The pizza is the company. Just as a pizza is divided into slices, a company is divided into shares. Each share represents a portion of the company's total value. Each slice is a share. The more shares you own, the larger your portion of the company. If the company grows and becomes more valuable, the value of your shares can increase. Just like how a pizza slice might become more desirable if it's from a popular pizzeria. The more shares you own, the bigger your slice of the pie. Owning more shares means you have a greater claim on the company's assets and earnings. This can lead to higher potential returns, but it also comes with higher risks. Stocks are traded on stock exchanges, like the New York Stock Exchange. These exchanges are marketplaces where buyers and sellers come together to trade stocks. The prices of stocks are determined by supply and demand, which can fluctuate based on various factors such as company performance, economic conditions, and investor sentiment. Prices go up and down based on supply and demand. When more people want to buy a stock, its price goes up. Conversely, when more people want to sell a stock, its price goes down. This constant movement creates opportunities for investors to buy low and sell high, aiming to make a profit. However, it's important to remember that investing in stocks also carries risks, and prices can be unpredictable. Some companies share their profits with shareholders. This payment is called a dividend. Think of it as a bonus for owning their stock. Dividends are usually paid in cash, but can also be additional shares. Not all companies pay dividends. Some reinvest profits back into the business. Dividends are a way for investors to earn passive income. It's like getting paid rent on a property you own. Your portfolio is your collection of investments. It's like a basket holding all your stocks. A diversified portfolio is key to managing risk. Don't put all your eggs in one basket. Spread your investments across different companies and industries. A well-balanced portfolio should align with your financial goals and risk tolerance. It's important to review and adjust your portfolio regularly. Section 5. Bull versus bear. Understanding market sentiment. In this section, we will delve into the concepts of bull and bear markets, which are fundamental to grasping market sentiment. You'll often hear the terms bull market and bear market. These terms are used to describe the general direction of the stock market and the overall sentiment of investors. A bull market is characterized by rising stock prices and investor optimism. During a bull market, the economy is typically strong and employment levels are high. Investors feel confident, and this confidence drives stock prices higher. Think of a bull charging forward, pushing prices higher. This imagery helps to visualize the aggressive and upward movement of the market during these times. Bull markets are generally good times to buy stocks. Investors are optimistic about future growth and are willing to invest more money into the market, expecting higher returns. A bear market is the opposite. It is a period when stock prices are falling and investor sentiment is negative. It's marked by falling prices and pessimism. During a bear market, the economy may be slowing down, unemployment may be rising, and investors are generally fearful about the future. Imagine a bear hibernating, pulling the market down. This imagery represents the sluggish and downward movement of the market during these times. Bear markets can be challenging, but they present buying opportunities for savvy investors. While the general sentiment is negative, experienced investors may find undervalued stocks that have the potential for significant gains once the market recovers. Understanding the cycles of bull and bear markets is crucial for making informed investment decisions. Historically, markets have always moved in cycles, and recognizing these patterns can help investors strategize better. By studying past market trends and cycles, investors can gain insights into potential future movements. This knowledge can be invaluable in timing investments and managing risk. It's important to remember that both bull and bear markets are temporary phases. Long-term investors should focus on their overall investment strategy and not be swayed by short-term market fluctuations. Diversification and a well-thought-out investment plan can help mitigate risks during bear markets and maximize gains during bull markets. Consulting with a financial advisor can provide personalized guidance tailored to individual financial goals. In conclusion, understanding market sentiment and the dynamics of bull and bear markets is essential for any investor. By staying informed and strategic, you can navigate the ups and downs of the market with confidence. Section 6. IPO, when companies go public. An IPO, or initial public offering, is when a private company first sells shares to the public. It's like a company's debut on the stock market stage. IPOs can be exciting investment opportunities, but they also come with risks. It's important to carefully research a company before investing in its IPO. IPOs allow companies to raise capital for growth and expansion. They also provide an exit strategy for early investors. Section 7. Market indices. Tracking the market's performance. Market indices like the S&P 500 and the Dow Jones track the performance of a group of stocks. They provide a snapshot of the overall market's health. Think of them as report cards for the stock market. Indices help investors gauge market sentiment and track their portfolio's performance. The S&P 500, for example, tracks 500 large U.S. companies. It's considered a benchmark for the U.S. stock market. Section 8. Volatility, the roller coaster ride of investing. Volatility refers to the price fluctuations of a stock or the market as a whole. It's the up and down movement of prices. High volatility means prices swing dramatically like a roller coaster. Low volatility means smoother rides. Volatility can be driven by factors like economic news, company earnings, and investor sentiment. It's important to understand and manage volatility in your portfolio. Section 9. Keep learning. Your journey to stock market success. Congratulations! You've learned some essential stock market terms. But this is just the beginning of your investing journey. Keep learning, exploring, and asking questions. The more you know, the better equipped you'll be to navigate the exciting world of investing. Remember, investing is a marathon, not a sprint. Start small, diversify your investments, and stay informed.